Tax-saving strategies every investor should know. I think it's safe to assume that everyone wants to pay fewer taxes. We are all investing to achieve certain objectives. What we hope to accomplish differs from investor to investor, but I think we can all agree that we want a larger portion of our returns to go toward achieving our objectives and a smaller portion to the Internal Revenue Service. Do you not know where to begin? Take into considerations. Which types of investments should I go with? Where is the best place for me to keep my investments? When is the best time to sell my shares? In what sequence should I take my money out of my investments? How can I maximize the impact of the donations I make to charity organizations? These are 6 of my favorite ways to reduce the amount of taxes owed on investments. Number 6, take into consideration funds that are tax efficient. When selecting investments for your portfolio, you need to keep several considerations in mind. When it comes to your non-retirement accounts, investment returns and tax efficiency are 2 important factors to take into mind. You presumably want to get the highest possible profits after taxes from your investment portfolio. One strategy for minimizing the amount of returns that are lost due to taxes is to select assets that already have built-in tax efficiency, such as index funds. This strategy also applies to certain mutual funds and ETFs, exchange-traded funds. There is a possibility that ETFs will provide an additional tax benefit. Because of how their transactions settle, they can evade the recognition of certain capital gains. ETFs provide the best of both worlds when it comes to investing, cheap costs and tax efficiency. For this reason, I frequently utilize ETFs as the basis for the portfolios of some of my clients. Note that because index mutual funds follow a benchmark, their objective is to achieve the same level of performance as the benchmark. These investments might not be the best choice for you if your goal is to achieve a better return than a particular benchmark. Number 5. Consider the use of actively managed funds with a primary focus on minimizing tax implications. Some of the clients with whom I work are interested in having their investments actively managed, but they do not want the additional tax liability that may be associated with this strategy. When I am building investment portfolios for such clients, I may choose funds from the tax-managed investments offered by Vanguard. They provide active management with a particular emphasis on tax optimization. When working with customers who are in higher tax brackets, we may explore investing their money in tax-exempt bond funds. These funds offer lower interest rates, but their returns after taxes are higher. In the course of my work with clients, I incorporate strategies for the tax-efficient location of assets into their financial plans. This enables them to preserve a greater portion of the returns they earn. Number 4. Allocate the assets to the appropriate accounts. One way to optimize after-tax returns is to select investments that have favorable tax treatment. However, it is also important to select the appropriate sorts of accounts in which to hold your investments. At its most fundamental level, asset location refers to the process of minimizing tax liability by allocating one's assets between taxable and non-taxable accounts. Therefore, you will retain investments that are tax-efficient in taxable accounts while you will place investments that aren't tax-efficient in accounts that allow you to defer taxes. In the course of my work with clients, I incorporate strategies for the tax-efficient location of assets into their financial plans. This enables them to preserve a greater portion of the returns they earn. Accounts that are subject to tax should contain tax-efficient assets such as mutual funds that track an index, ETFs that track an index, free from taxation bonds, a stock. These are examples of assets that should not be held in a non-taxable account. Mutual funds with an active management strategy, bonds that are subject to taxes. Number 3, be on the lookout for ways to reduce your profits. As an investor, you are only subject to taxation on your net capital gains, which are defined as the amount you receive minus any investment losses. Hence, any realized losses might assist in lowering your overall tax liability. Because of this, if you are aware that you are going to make realized gains, it may make sense to hunt for opportunities to create realized losses so that you can balance out your gains. For instance, if you have shares of funds or stocks that have decreased in value since the time that you bought them, you might want to think about selling them. Tax loss harvesting is the process of purposefully selling investments at a loss to reduce one's overall tax liability. If you have a year in which your capital losses are higher than your capital gains, you can deduct up to $3,000 of your annual net losses against your regular income on your federal income taxes. This only applies to years in which your capital losses are higher than your capital gains. It is also possible to carry forward losses to subsequent tax filing periods. Before deciding to use this strategy, you need to be aware of the laws and restrictions that are associated with tax loss harvesting. These rules and restrictions include the wash sale rule. Number 2, make sure your withdrawal order is optimized. Make certain that your withdrawal strategy takes into account the cost of applicable taxes before you begin withdrawing money out of your portfolio. As soon as you begin withdrawing money from your non-retirement accounts, you should consider transferring any income generated from your investments, including dividends, interest, and capital gains, to the money market rather than reinvesting it. This will prevent you from having to pay taxes on the same money twice. You will be responsible for paying taxes on the income that was earned as well as capital gains taxes on the appreciation if you reinvest the money that was made and then sell the shares for a profit. One of the ways I help my customers keep as much money as possible in their pockets is by utilizing an approach similar to this one. Number 1. Make the most of the donations you make. It is possible to give in a way that will help you pay less in taxes if philanthropy is one of the aims you have for your investments. Take into consideration the following tips to get the most out of your charitable contributions. Include your monetary donations as an itemized deduction on your tax return to qualify for tax breaks, up to certain restrictions. Donating securities that have increased in value, such as mutual funds, exchange-traded funds, or individual stocks, might help reduce potential future capital gains. Because not all charitable organizations are permitted to accept donations of investments, I frequently recommend to my clients that they contribute to a donor-advised fund like Vanguard Charitable, which makes the process simple. Acquaint yourself with the concept of donor-advised funds. Through a process called a qualified charitable distribution, you can take money directly out of your retirement account, IRA, and give it to a good cause, up to a certain limit each year. The distribution should not be considered taxable income as long as certain conditions are followed. These rules include being at least 70.5 years old when making the gift and having the check made payable directly to the qualified charity. It is possible that the funds will not achieve their goal of being tax efficient, but it is also possible that they will. You may be responsible for paying taxes on any capital gains made through the trading of the fund or by your redemption of shares, even though the income generated by municipal bonds that are held by a fund is exempt from taxation at the federal level. When it comes to some investors, a portion of the fund's income can be liable to state and local taxes, in addition to the alternative minimum tax levied by the federal government. Tax loss harvesting involves certain risks, including the risk that the new investment could have higher costs than the original investment and could introduce portfolio tracking error into your accounts. Tax loss harvesting involves certain risks. There could also be unanticipated repercussions for taxes. Before you take any action, we strongly suggest that you first consult a tax professional and then carefully go over the terms of the consent. So this is the end of our today's video. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.